All right, everybody. Well, Merry Christmas, Happy New Year's. This is the video of all videos for me. This is my recap of all of 2023 and how I see 2024 playing out. We're going to talk ETFs. We're going to talk macro. You know, is this a retrace? Is this going to new all-time highs? We're going to talk Fed funds rate, what happened when they start cutting in 2024. We're going to talk about my kind of crazy, wild thesis. We're going to talk about all of it. And so let's just get right into it. It's going to be longer than my normal videos because I got a lot to talk about. So cheers. I got my coffee here on a Saturday morning. And let's get into this because we got some big stuff coming up here in the next week with the likely approval of the Bitcoin ETF. So let me pull up my notes so that I don't miss anything. Let me exit. There we go. Okay. Let's first start off by covering my general macro thesis recap on 2023. If you've watched and listened to anything I've said over the past, 12 to 18 months, I called the bottom back in January, I guess is what it was, of this year, and have been bullish ever since 16K. Admittedly, I got out a little bit late. At the top, I saw all the signs, but I ignored them. Mistakes be damned. But I did exit the vast majority of all of my positions in about April of 2022 when we had that retrace to about 48K. I got out at about 48K, watched it come all the way down, and then I started DCAing back into pretty much everything at 24. It was a little early, but I 24, 21, 18, and 15.8K was my lowest buy on Bitcoin. I got Ethereum. I got a ton at 1100, some at 890, just above or actually it was 910. It was right above the all-time low, and a bunch of other stuff. I am sitting pretty right now, very pretty in terms of the ROI on those investments, call it a year later or so. And my general thesis for this entire time has been either one of two things is happening. Either this is a massive retrace, and we're going to go to 618,786 fibs on Bitcoin and crypto, and the equity markets are going to replicate exactly what Bitcoin did in 2021, just over a slightly longer period of time. They're going to double top, and then everything is going to roll over. We are there. We are in the biggest danger zone, in my opinion, because we are sitting at I gotta go through all of my. I have so many charts up. Forgive me for not being able to get to them quickly. But the long and the short of it is, let me actually show you the NASDAQ real quick. Just as one of my theses that I gave in the beginning of this year was that essentially crypto leads liquidity cycles. That it's ironically the second. It's a laggard on the way up, and it is a leader on the way down. In other words, Bitcoin and crypto, and if you look, there's been a lot of talk over the last year, not just from me, but from a lot of people that I think, the halving theory of like everything that is cycle driven for Bitcoin is based upon the 4-year cycles and the halving and all of that. A lot of that it hasn't been debunked by any means, because until it's been proven wrong, it's not necessarily wrong, but there is a very clear correlation with global liquidity and these cycles of Bitcoin, which just ironically line up with the halving. Maybe Satoshi knew this, who knows, and that's why he designed it this way. Nobody will ever know. But regardless, there is a clear correlation with liquidity, when liquidity increases, Bitcoin goes up. When liquidity decreases, Bitcoin goes down. And the stock market is fairly similar as well. However, what you will notice is that as liquidity increases on the way up, Bitcoin waits and crypto waits for there to be new all-time highs in the Dow Jones, in the S&P before it moves. If you go back and look at the cycles in 2017, the bull cycles in 2017, and you look at the bull cycles in of last year, in 2020, Bitcoin, when it finally made its move, around, let me actually pull it up here. I need to get just a regular S&P. Hold on a second here. Just need to get a regular S&P chart so that I can go through this thing. Okay. And actually, it's the Dow is actually even more correlated. So if you look at the Dow really started to make new all-time highs here in November of 2020. When it finally broke here in November of 2020, well, that's when Bitcoin went on its run. It hit all-time highs. It followed. As soon as the Dow broke, it broke. This has been replicated several times over the past few cycles. And so in other words, Bitcoin follows the Dow and equities on the way up. But on the way down, it doesn't follow them down. It leads them down. And I made this wild, crazy prediction a year ago, which basically said, I believe, or how wild would it be if because looking at these liquidity cycle correlations and whatnot, and how Bitcoin essentially leads on the way down by 6 to 12 months, sometimes as much as 18 months. How wild would it be if this pattern, which Bitcoin did in 2021, was replicated by the stock market? And it took a little bit longer to play out than I would have initially thought. But we are here, and it is wild, my friends. If you look at this, if you look at this as the equivalent of the 2021 April top for Bitcoin, we then crashed down here, had the same kind of bull flag Wyckoff accumulation pattern playing out here. As we did here. I mean, literally identical, with the spring that pops up, with the spring that pops up. And then it runs up, has the same bull flag continuation pattern, and then on to new all-time highs that we had here. Bull flag, bounce off support to new all-time highs. Bouncing off of that, those roughly, the bull market support bands, and on to do all-time highs. And so I was like, how wild would it be if it did this, put in a slightly higher high? If Bitcoin, Bitcoin is, it did about, 8%, give or take, about an 8% move higher. If you look at the NASDAQ, 8%, give or take, from here, it'd be like what, like 17, well, 6, let's just call it 17 is 84, or sorry, 87. Yeah, so call it 82, 18,000, maybe 200, give or take, would be about the equivalent. I'm rough estimating right now. But that would be the NASDAQ. S&P did, assume the S&P were to do something similar. Anyways, that has been the biggest scary moment. And then I said that, okay, how wild would it be if it did the exact same thing? It leads liquidity cycle. We then have the equity markets do basically the same thing, put in a slightly higher high, double top, and then everything rolls over. Everything rolls over. Crypto rolls over, equities roll over, everything rolls over. And that I said that, like, if this were to be the case, that Bitcoin would not get to a new all-time high. That what would be the likely scenario, if it leads the liquidity cycle on the way down, is that it would only get to a retracement level, and that it would only get to, roughly the 618 or 702, which would put it, okay, in somewhere in between 53 and 48. Okay, so somewhere in this range is ultimately where it would go. Well, here we are finding ourselves right now just above the 0.5 retracement level, just before ETF news. And I was saying in the Discord, how ironic would it be if we got to this range, dropped to call it like that 42 range, which we're playing now. I've always said, like, on approval, we get a 10K green candle, and that it is likely that they sell the news event. I think it's debatable on whether it's a short-term sell the news. We'll get into that. But that, like, ironically, where is that going to put us next week when this thing likely gets approved? If we're at 42K, we get a 10K green candle, where are we going? We are going to go exactly where I said we are going to go, which is we are going to go right here into that 52K range, into that 702, or between the 618 and 702. At the same time that we are going to be replicating the exact same pattern that we did in crypto just 18 months later. It is a wild, I said, like, do we live in a, if there is evidence of living in a simulation, this is it. So now, with all that being said, I had either we're going to go to all-time highs, or this was going to be this was going to happen, right? Like, this is the end of it all. Now, with that being said, my case for this was that if we were to do this, if we were to go into a retracement, I would be looking and to determine whether or not, like, is this a retracement, or is this building a bullish case as we enter the halving cycle? Is there a possibility that this is not just a retracement? Is it the possibility that, like, we break new all-time highs with the stock market, which is typically a leading indicator for Bitcoin on the way up? Remember, Bitcoin leads on the way down, stock market leads on the way back up. Are we going back up right now? And is it the leading indicator? We need to break all-time highs in the stock market for Bitcoin and crypto to follow. We are now doing that. And so what is it? Is this my prediction of a year ago, where this is just a massive retracement and we're going into rollover, or is this the setup to go to new all-time highs? And that argument that I have laid out in multiple videos has been, I had two requirements that would maybe nullify the retracement theory, which was that Bitcoin dominance stayed strong, that this did not do one of these, okay? Because this typically only happens, these massive moves down only happen in true bull markets. Once Bitcoin has reached a new all-time high, and then everything floods into alts, and then you have your Pico tops right here, right? Like January 2018, December of 2017. Same thing here. You have your April 2021. So you have this move down. I did not want to see this move down until we reached a new all-time high. That I wanted to see a slow chug up in Bitcoin dominance the entire way. And you got to get into these arguments with these dumbass people on CT that are just so blind. They think Bitcoin dominance going up is just bad. It's not bad. Dominance going down is generally always good for the entirety of the market, but Bitcoin dominance going up can either be good or bad. And a lot of people just assume it's always bad. It is not always bad. It is bad when the entire market is crashing because money flows into Bitcoin, and so that increases its dominance because Bitcoin loses less than its counterparts. But it is good at two phases: at the very end of a bear market, as it bounces out of the depths of despair, so to speak, and also once it's then had its time capitulation over a year or however long a bear market needs to take place, that its first powerful move into its all-time high and first initial surge through, that burst is important for Bitcoin to have. We have had all of those. We had we had this, here we are at the bottom, and we had an initial burst out of the bottom here from November 22 into March of 23. That initial exit out of the bear market was up for Bitcoin dominance, yet it was good for the market. That's how these things work. And that I wanted to see some continued strength, that I did not want to see us rotate into alts too heavy, too early, because to me, that would scream retrace. That, in combination with, I drew a bunch of, lines a while back, which said, like, if this was back here, I was like, if and when I think I started to draw it when I first came out of here, I was like, if Bitcoin does something like this, that would have me worried, because it would be too far, too fast. We would see the Bitcoin dominance go down, and this would be an ultimate collapse. Quick side note, 12K, it'll never exist. Don't follow idiots who tell you it's happening or it's coming. It is not. Either this was a generational bottom, or we are going far, far lower. And I'll show you why in a little bit, but it's not happening. You're nobody, just like I have, I'll get into my whole thesis for why I don't believe we're in for an economic collapse. It's the same thing with these 12K callers. One of the biggest red flags for me, and then I'll get back to this, one of the biggest red flags for me in the 2022 was how many people, not only in Discord, in our Discord, but how many people in general were saying, I'm going to wait for 10K, for 12K. I'm going to load my bags. I was like, that's not how the markets work. The markets don't give you that. And so as soon as you see everybody and their mom calling for how they're going to wait for this generational bottom and buy everything up, like they're savants, like from The Big Short or something, and that it's going to then go to the moon and they're going to become bajillionaires, it was like, we've already seen the bottom. We've seen the bottom. It's not happening. It was the Capo syndrome. And so it's not happening. There are only two scenarios. Either you missed it, partner, or B, you're not going to make your money, because when you do buy, we're going significantly lower. And that has also been my general thesis for this entire time. So back to this. So again, my general thesis on this has been, what am I doing here? What is happening? Is that if instead of retracing heavily, we built out a long base of support over the course of a year, which is exactly what we've done, that in combination with a strong Bitcoin dominance was the necessary requirements for a potential new bull run. And that's why I'm so split here, because it would have been easy. It would have been the easiest trade in the world if this had moved up quick, Bitcoin dominance had fallen, I would have exited the entire market. And it's why when I originally listed kind of my take profits, I was originally going to take some small profits at 30, but I was going to take a massive profit take right now at this 44, 48 range. If we had Bitcoin dominance going down, and if we had risen sooner than we did. As soon as it started to play out in a much longer time frame, as soon as Bitcoin dominance kept its strength, I reduced the amount of profit. Maybe I'll regret it, maybe I won't. We'll see. But I took a significantly smaller piece at 30, and a super significantly smaller piece at 44. I sold some, but did not sell nearly as much as I had initially planned because of how it's played out. I think there's a much stronger case to be made for a bull market moving forward from here. Let me talk about that 12K thing for a second, because I think this is hilarious. So this is, and just dividing things by M2 doesn't tell the whole story. There's a lot of other things that factor in, but one of my theses is against an utter collapse of the economic system, or at least an economic collapse from a where are we going to go on the S&P, the Dow, the NASDAQ, or Bitcoin, et cetera. Are we going to collapse to just crazy all-time lows, and is it going to be 1929 reincarnate? I don't think any of that is the case. And one of the biggest reasons I don't think that's possible is we have too much money and too much liquidity in the system. And yes, I know there has been some form of monetary tightening that has taken place, although not nearly as much as the Fed would have liked you to believe. I think that ultimately we printed 30 to 40%, whatever the number was, of the amount of money in circulation over a course of 3 years that's ever existed. I don't think we can go that low. There's just too much money. And the problem is that that's why you see inflation through the roof. Like, it has been a secret tax on everybody. And if you take a look, where does this line up? So we dropped, most people think, right? Like, this was 18K, right? If you divide it by M2, and if you look at all the 12K calls, right? Like, if you look at all the people calling for 12K, they call for 12K because it kind of lines up with this support range right here, right? Here's your 12.5. And so people are like, oh yeah, it's gonna go to here, right? Because you got this kind of support right here, right? So like, okay, that's why it's going to 12.5. Okay, let me show you something. This is your 12.5 support, right? That people like to try to call. Well, isn't that ironic? Isn't that ironic that when you divide by M2, we basically got to the equivalent of 12.5. We've already been there, people. We've already been there. And it got front run by people like yours truly, who bought it at 15.8 at the bottom of 50, just barely missed the pico bottom by just a few $100s. We've been there. It's not coming. And if it is coming, then we are going significantly lower than 12.5, my friends. We're going to visit 3, 5, 7K Bitcoin, and it's just a total economic collapse. But I don't think that's happening. There's too much money in the system. We're not going there. And I think the same can be said for the S&P. So here is your, what did I do this for? Oh, yeah, no. I don't know why I have it. Maybe that is the, oh no, I know what I think that's the Dow. Look at the Dow. Yeah. Okay, sorry, distracted. So here's your S&P, right? Just breaking into new all-time highs. Yep, right? Touching those 2021 numbers and significantly higher, right, than 2008 numbers or the, pre-COVID numbers. Or are we? Here you go. This is your S&P divided by M2. We have been in a channel since the dot-com bubble burst of 2000, where we were severely overvalued. We then printed our faces off over the last however long. This was our Great Depression. I'm sorry, your 1929 callers, this was your Great Depression right here in 2008. And the reason why we didn't go any lower than we already did is because we had the tools to save ourselves from it that we didn't have in 1929. Everybody is they don't realize that 08 was our Great Depression. We already had it. We've been there. That was it. And the Fed stepped in and printed money because they had tools now and knowledge now that they didn't have 80 years prior. And the amount of recency bias that exists in the market with here, I took pictures because this is the shit that drives me insane. Okay, here's a couple. Can you see this? Look at this. Okay, this is a couple of your YouTubers, and these. Can you see this? Look at this. I think it's backwards, so you can't read it. But it's all impending doom videos. You know why it's impending doom videos? Because that's what gets clicks. People want to become the next Michael Burry. People want to be the Nostradamus of the markets and become famous. That on top of the fact that it gets clicks. People are saying it's going to have a massive blow off top, or it is going to go to zero, because that's what, if you just say, hey, it's going to be mediocre, no one's going to click on your shit. And so I think we've been led astray by too many people. There are, we've already had our Great Depression in my mind. And yes, our valuations extended, of course, but that's why I think we're in for a period of mediocrity, not collapse, not blow off tops. I'm going to go over different scenarios, but here is your S&P divided by M2, because the government has stolen so much of your money through inflation and money printing and zero interest rates. So we are not this is not some crazy bubble. This was a bubble. 2000 was a bubble. Are we extended? Yes. But what's going to happen? Maybe more of this. Unless, and I'll get to this wild thesis that I have, that basically would invalidate my earlier things, which is this is what we're in for, because we have now broken out of it. So are we doing a slight deviation, or is this thing about to run and do another one of these? So, let's walk it back here a little bit. Here's your NASDAQ divided by M2, by the way. If you look at this, we're still not at blow off top territory. But I believe we are in, let me make sure before I go to my next period of things here. I believe we are not, to reiterate what I said earlier, I believe we are, I don't believe in a complete economic collapse. I believe in mediocrity for the next 10 years. But I think it's going to be delayed, and I think the first half of 2024 is going to be good. And I think there's a chance the latter half of 2024 is not going to be good. Why don't I believe in an economic collapse? Let me tell you why. Because you can't have a major economic collapse without a major collapse in the real estate market. And we have not seen that. And we don't have a catalyst for it right now. It doesn't exist. I think there is, the markets are generally much more resilient than people are giving them credit for. You have people locked in at these extremely low interest rates. This ain't going to be 2008, where people were like so over leveraged. They were underwater on their homes. They were taking out interest only loans or neg am loans. That was a cesspool of degeneracy from a real estate standpoint that was utterly unsustainable. The only thing that is unsustainable right now is the interest rate component of this. People are paying their mortgages. There are not foreclosures. There are not people in over their heads. And so you have the baby boomer generation that has a fuck ton of cash, and who own the vast majority of the market. It's not going to happen. There is not a real estate collapse coming. I'll get to what could be the catalyst for a crazy blow off top here in a second. But the bottom line is I don't see that coming. That's the biggest reason why I don't see it coming. Could you have mediocrity? Could you have recession? Could you have all of those things? Absolutely. But again, the recency bias makes people think that the only thing we can have, right? The only thing that we can have is that we have to have this. We have to have 2000.com bubble burst, or we have to have, the S&P collapsing in 2008, or we have to have a COVID, or we have to have a blow off top. That we can't have normal 30% recessions. Guess what, people? That is what has existed in the world for the vast majority of the time. Recessions don't have to be catastrophic in 50 to 60% declines or 80% declines. We can have 30%, we can have sideways. And unless we were to have a real estate implosion, we're not having a 50 to 60% collapse. It's not happening. Even if you look at the dot-com bubble burst from the 2000s, we didn't have a major recession. There was not a big recession here. This was just a bubble that popped. Okay. And only the NASDAQ had a major decline. We didn't have a major recession. The economy was actually pretty strong during this time. Now, do I think we could lead to this and have something similar? Yes, and I'll explain my thesis as to how that could happen. But to assume that we are going to replicate 1929 is a fool's errand. Not to mention that if you believe the government is as corrupt as I do, they're not going to let this thing implode here in the beginning of 2024 or an election year in general. They're going to do what they can to kind of prop it up to mitigate their involvement as much as possible. And so, and here's the other thing. I think the government, so you might ask, okay, so why are they cutting rates, right? We're going to get into this rate thing here in a little bit because, well, the Fed funds, right? Like every time they cut rates, the economy collapses. But we're going to do a little game that shows you that's not exactly how it works. And I had bought into the same theory that everybody has been pitching, right? And kind of why I got caught off guard on exiting the market in November, December of 2021, because I was assuming it was going to play out like it always had, and it didn't. And it is different this time, and I will show you how and why. But I think the government secretly, I think part of the reason why they want to cut rates is I think they need inflation high. Call me crazy. I think they, not high, because right, too high collapses, crushes everything, and that will and can cause major economic pain. However, a slightly higher rate of inflation can reduce the debt burden that is afflicting the U.S. right now. We have a ton of debt. We are in a debt-based economy, which is why I think the reaction to the Fed rate cuts is going to be different this time. But I think they need inflation slightly higher. I think the Goldilocks zone, they don't want to get it down to 2%. They want it, in my mind, between 3 and 4. Anything over 4 gets a little high, like if you start getting like 4.5, 5. But I would say 3 to 5 with a 3 to 4 preference. They want this to kind of lag out in that 4% range for a little bit of time, because that will eat away at the government debt. And I don't have time to go into that and how it works. But basically, inflation eats away at debt, period, right? Let just theoretically say you bought a house today for $500,000, and let's just theoretically, just for the sake of this argument, you didn't have to pay. You didn't have to pay any of your house. You got a freebie loan, right? Pay 0% interest on that $500,000. Well, I want you to fast forward 30 years, right? And they say you didn't have to pay anything for 30 years. You got your house for $500,000, but you didn't have to make any payments on it for 30 years. No interest accrued, nothing. Well, 30 years from now, even if you assume a moderate rate of 3% over the course of that 30 years, right? Well, that's at minimum, like that's 100% inflation rate over 30 years. Probably it's actually a little bit more than that. Let's call it 120%, right? So in other words, if you had $500,000 is essentially cut that in half, a little bit more than half, because of the inflation rate, right? Because for that same house 30 years from now, that 500 is going to be like 1.2 million, give or take, right? Which means that $500,000 is really but you still have a $500,000 loan on that house, so it's like the equivalent of what would have been 250. It eats away at the value. That's the long and the short of it. That's a TLDR of how inflation works. And I think there's a part of them that wants to see it eat away at government debt. And I think part of the reason why they're cutting early is because the rates are so high, and so they can't afford the interest payments on their debt. And so I think because a lot of the issues aren't really economic, they're government based. So anyways, I think there are generally two scenarios. Either this is 1967 or 1995. Another thing that I have been dead right on is that I stumbled upon this as I was charting forever ago. And I looked at periods of inflation, right? Really, the only big times you have are the 40s and the 70s. before. Now you have spikes here and there, but like entrenched periods of time for like a decade or so was the 40s and the 70s. And are we going to repeat that? And what did that look like? What did the markets do? All that good stuff. Well, ironically, here is, if you were to look at this chart, not look at the dates at the bottom of the screen, this would look very, you realize this is now, right? This is now. This is, here's your .com, right? Here's your 2008 financial crisis. Here's your run up. Here's COVID. Here's our all-time high. Here's our drop that we just had. Here's our, you know what I mean? Right? No, this is the late 50s, early 60s. And it looks like the same fucking chart. It's the same fucking chart. So here is your .com and your 2008. Here is your COVID. Here is our high. Here is our retest. And what I said is, I said, man, we are following this to a T. That back in like October, I think it was, when we hit that low, I was like, everyone's like, oh, we're going to go to fucking Doomtown again. I was like, no, no, no. If we are going to repeat, what's going to happen is we are going to bottom right here, put in a ever slightly lower low, but still significantly higher than our bottom, and then pull a double top. This goes back to my original thesis that I've been talking about for a year, right? That we double top it. And what do you know? What have we done? Almost identical. What do? We put in a slightly lower low and then ran it up double top. We had the same back test here on the top of the previous COVID all-time high as we did back tested here, previous all-time high, double top, and then we rolled over, right? But then what we did is we entered the period of the 1970s, okay, where we went sideways. And this has been my base case, that this is what we are in for. Not a collapse, not a blow off top, but that we are, and this is the danger zone we're in right now. It's what I talked about in the very beginning of the video, right? That this is the danger zone we're entering. We are entering the danger zone here while we reach 618 to 786 fib retracement on crypto, and that ultimately we are in for a drop, a new higher, a bunch of sideways wasted decade. Okay, I think that is still there is still a strong case to be made for that. And it is still my base case. However, I would like to show you and offer a potential wild scenario that if, because again, my thesis is we are either in the mid 90s or we are in the we're in the 1968 to 72, right, leading into the 70s. So we are either leading into a period of mediocrity, or we are leading into a blow off top, and we are in the mid 90s right now. Those are the two scenarios that I see. The question is which one, right? And here is the Fed funds thing. We're gonna play a little game. Here's the Fed funds chart, right? All the way back from the 1950s till now. You have the Fed funds rate in orange, and I believe this is the Dow. Oh no, it's S&P. The S&P in the blue. And we're gonna draw some correlations here. Okay. Poor people who bought houses here in the late 70s. But anyways, so let us go here, because the general thesis has always been rate cuts lead to recessions, or a part of the process in recessions. First off, know that rate cuts don't generally lead recessions. They are a reaction to recessions. They are a reaction here. S&P drops first, then the Fed starts cutting. S&P drops first, then the Fed starts cutting. You go here into the 70s. There's a lot of sideways chomp here. But again, you see the S&P drops first, then the Fed cuts. S&P starts dropping first, then the Fed starts cutting. So we go into a recession, and then the Fed starts cutting, right? That's how it has always worked. And generally speaking, when the Fed rates go up, the market kind of moves up with it, generally speaking. Okay. And again, it's always, it's a, what's what I'm looking for? Again, the reactive, not predictive. So anyway, so you get through the 80s, right? And they finally start to cut, and then we start to get into this zero rates for eternity. But the bottom line is, generally speaking, when rates drop, okay, markets go down, rates follow dropping shortly thereafter. Okay. Remember that. Market drops, then very slightly after, rates drop. They finish the collapse. At the bottom, stuff starts to turn around, and then rates start to go up again. Okay. Here's your anomaly, which we're going to talk about here in a second. We had a huge rate drop here. We had a little bit of a recession here into the 90s, where the Fed started to cut early for the first time, really. Most everything was, they started to cut a little early. They bottomed out, then they started to raise them, and it went into this crazy blow off top. But let me show you something that happened here in this most recent time that I think most people ignore. So again, for the most part, over time, we see a correlation between recession and rate cutting. Typically, recession leads, then rate cut, but they're very close and they're very linked, right? Same thing happens again here. This actually is more simultaneous, so huge rate cut and a drop simultaneous. Okay, market goes up, rates go up again, give or take, we're at the top, cuts and into recession, right? Correlation. Cuts are bad. That's what your boy thought too. Cuts are bad. Cuts signify shit is bad, gotta stay away, right? Except maybe not. All of these have taken place long before we got to that zero rate total degeneracy that we had from 2010 until basically now. Most people will look at this. Most people will see, so we're at zero, and then we started to increase rates, right, in 2016. And the market was like, I don't like that. Let me zoom in a little bit. Most people, when they see this rate cut, they associate this rate cut. They're like, oh, look, see, rates cut, and we had a fucking COVID crash. I think that's moronic to look at. COVID was a fucking anomaly. It was random and out of nowhere. And the reason the Fed started to cut rates is because of the repo and reverse repo markets were like a shit show, and there was some stuff behind the scenes that was not looking good. So they came in and saved the market. We started to like have some big sell-off here, right, in 2018. And that's when they were like, okay, we got to knock this shit off. And then they paused, and then they started to reduce, and it started to go up. Only COVID brought this down. I am a firm believer that had COVID not happened, this would have continued. This would have continued regardless. We would have kept going up. And I think it's because we're in a different debt-driven society now. Because I was under the impression of, oh, rate cuts are bad, but there's a lag effect, right? In other words, if you look at all of these rate cut cycles previously, right, increasing the rate doesn't drive the market down. In fact, it goes up. Only after the pause and it starts to decline, the markets go down. So when I heard in November of 2021 that they were going to raise interest rates, I was like, well, if that's the case, we got time, because they're going to come up, they're going to pause, and then when they go down, that's when the market's going to go down. The market did not like those rate cuts, and they reacted extremely negatively to them, along with inflation, some other things. But They reacted extremely negatively. I believe, and here's my, I think, again, base thesis, sideways for a decade. We're getting close to that double top. It's very scary. We're going to see what happens. However, I think there is a chance, especially with how I've seen this play out, with the liquidity cycle increasing and the Fed now talking about rate cuts next year. I think there is a chance that we are in the mid 90s right now. And I think there is a chance that everybody's going to get cut offside, that the AI base case is going to surge again. This crypto stuff is going to surge again because it's a new era. We got the ETF, we got regulatory clarity. AI is going to change the world so similarly to what happened in the late 90s and into 2000. We're going to get it while we get rate cuts. I'll show you again the late 90s chart, how it was the rate cuts are very similar reacting, how they reacted back then. And so I think what's going to happen here is I think we are not going to have a random, I mean, I guess we could, never say never, I guess, but I think when these rates get cut, I think you're going to see a spike. And I think you're going to see a continued spike. And one of the biggest reasons I think you're going to see a spike is because we're drunk. And I think this is what we saw here. I think we're like, market said we don't like higher rates. We've been drunk on this for a decade. We can't do this. And so the Fed was like, fuck, okay, we won't. The market loved it. COVID was an anomaly that doesn't really, I don't think, fairly take this into account. And I think that is what happened again. We started to raise rates. Market's like, we don't like this. They're like, okay, we're going to pause. And when they cut, you will see another burst here, just like we did in 2019. I believe we see it again. And one of the biggest reasons in catalyst, I think we're going to see it is because, and I think the government has to do it. I think they want inflation, and I think they need to get their debt burden, their debt payments down. So they have to do it. And I think they're willing to risk inflation to do so. And I think the first thing you're going to see, this goes back to why we're not going to have a complete economic collapse, is that we don't have a catalyst for the housing market to collapse. And I think we're going to see the opposite. I think when they start dropping rates next year, assuming they do, I think you're going to see a massive surge in homes and home prices again. And this is going to be the blow off top bubble, because people are going to start buying homes again as soon as rates drop. They don't need to get back down to the 3% range, even if they're in like the 4 and 5% range, which I think is highly likely if the Fed does what they say they're going to do. And so I think if and when the Fed starts cutting rates, they're doing so in the market moves down first, and we still haven't seen the market in a recession. Is it possible? Of course. I personally, as a business owner, I don't see it yet. I'm not seeing, there's slight signs, but I think it's signs of mediocrity, of things are slower. I don't think it's signs of total economic impending doom. I just don't. And maybe I'll get proved wrong, but I don't see it. And I think there's a strong likelihood that we enter a period of, when they drop rates, real estate goes insane. And when real estate goes insane, the markets will follow and go insane. And if they go insane, you're then going to see a blow off top. And then that is possibly the catalyst for a major economic all bubble return to, maybe all these blow off toppers will be right. But I think the catalyst for them to be right is the rate cuts next year and how the market reacts to them. So watch it closely. But if you go back and you look in this late 90s, we did the exact same thing. So we cut rates. We had a very minor recession in the 90s, very similarly to what we had in 2022. We had a very minor recession, very minor. We had 2 quarters of negative GDP. People can talk all they want. What is recession? What's not a recession? If it was or wasn't, we were right on the cusp. And it was slowed growth at the very least, which is very similar to what we got in the early 90s. And what they did in the early 90s is they cut these rates, and we weren't as bad of an economic spot as I think they thought they were. I don't even remember the reason why they cut the rates, but this early 90s rate cut, in my mind, fueled this. Oh, Jesus, what did I just do? It fueled this final blow off top. And I think there is a possibility of that. And those are my two theses. We're in 1995, okay? Or we are in 1968. It is one of two. There's some weird graphs, right? Like this one that thinks, shit, we are breaking out of a 20-year channel right now of when you divide by M2. And is this a deviation like this was? Are we going to deviate above, you know, how much we deviate? I don't know, right? But if rates come down, I think it's possible. I do. I think it's wildly, wildly possible. Yeah. That's my general thesis. People say like, well, how can the markets go higher? It's already they're already overvalued. I agree, but here's the biggest thing. I think the Magnificent Seven, the Mag Seven, is going to become the Lag Seven. I think they have owned and run the Nasdaq and the S&P for the last year and a half or so. Most of the gains have come from those. I think you're going to see a rotation out of them. They don't need to collapse. All they need to do is go sideways. If they go sideways and everything else catches up, which is typically what happens in early bull markets, the strong lead and the rest follow. I think you could get that. I think you could get them kind of lagging, moving sideways. I think you get a rotation into some other sectors that have underperformed. And I think what happens is those go sideways while the rest of the market catches up. That pushes the indices up higher. And then just as that happens, then you get your final push of everything right before it all goes to shit. Again, this is predicated on rate cuts and how the markets react to them next year. But you throw that in the loop with crypto. I think crypto's in a wild, weird spot. I think this could possibly be the last big cycle. I've kind of always thought that. I think this is the last significant halving. I think after this, it becomes fairly insignificant in terms of like everything's already out. Like you have to, it has some effect on miners, but other than that, it doesn't really have an effect on the total supply enough, in my opinion. And so, sorry, I lost my train of thought there for a second. The other thing I think that's weird about this crypto cycle is that we are in a period where I'm not even talking about institutions. I'm just talking about like mainstream adoption. Crypto was very niche in 2013, its first real kind of blow off top. It gained some traction in 2017. But the first time it was like everywhere, right? It was a part of Wall Street bets, a part of memes, a part of everything. Everybody sort of know about it. Like it was still like very niche, even in 2017. Like everybody and their mom knows about it, even grandparents, adults. But it was their first exposure to it. It was like, oh, hey, we've heard about it. Now we know about it. Which means I think that once these ETFs get launched, and if we do get a frenzy to rate cuts next year, that I think you could see larger than expected returns, because like people are going to be like, oh, I've heard about that, like now I'm in. Whereas before, like this 2020, 2021 was the first time people would kind of been exposed to it. You'll have the laggards now jumping in at the very end. I think there's a chance there's a left translated cycle, shorter. I think the highs come earlier and end sooner. I think we get to new all-time highs. Again, there's a lot of variables that come into play. I think we get into all-time highs in 2024, not 2025. I think there's a possibility that we see everything roll over before then. Again, all depends on how these rate cycle things play out. Election uncertainty, who knows what. But ultimately, I'll wrap up with this because I'm running out of time. Been talking too long. I believe we're about to get the ETF approved next week. I believe that when it gets approved, we see a 10K pump into that 48 to 52 danger zone, along with the equity markets breaching their all-time highs. I think there is going to, for that exact reason, for the same reason that I am nervous about this window that we're in, and because the news will have been all priced in at that point. I think there's a sell-off after that. How far down it goes, I don't know. Could be 40. I can't imagine it going below 32. I mean, ultimately, I think at this point, once we hit bull market zones, we stay above this bull market support band. Sometimes they don't come back and touch it, which is why we got too far ahead too early in 2021. That could happen again, right? But if it doesn't, and we do come down and touch, well, then we're going to touch. So we go up 48, and then again, this is assuming this goes somewhere around here, right? So what is that, like 37, 38, something? No matter what, I think we stay above this line. Whoops, we're not going below 31, 32, somewhere around there. That's the absolute, and I still think would be a wick and a quick swing up. But anyways, I think we put a 10K candle, we're at 42, we go to 52, 50, 49, somewhere around there. We retrace back to, call it worst case scenario, 31.5, 32, a likely scenario of, call it, 36, 35, maybe even as high as 40. Maybe it's not even that much of a drop, but somewhere in that range. And then I think the narrative is the halving, and then the narrative is the ETH ETF. I think all of those things, it is pretty wild. The amount of things that are lining up, it almost seems too good to be true, which is what's making me cautious and just very, just keeping a strong eye on these things. But the reality is the liquidity cycle has turned. Rate cuts are coming. I think people are going to react differently to rate cuts this time. I don't think it is going to be the doom and gloom rate cut that people think. I think it is going to be a drunken, drug addict fueled, thank you for my rate cuts, economy is still doing halfway decent, we're going to pile in, that could potentially send this thing off. But I'm watching this danger zone. This is a danger zone. I'm watching it like a hawk. If I see things I don't like, I'll start to exit more positions. But ultimately, if we get past, call it 53K, which is the 702, the top range of the 702, if we get past 53, we're going to all-time highs. So that's the range to watch. If we get past 53, we're setting new all-time highs. And it's going to be a fun year. I think the bulk of the gains will come in the first half of the year. I think it's once we get to the second half of the year, there's going to be a lot of uncertainty with all the shenanigans and shit shows of the U.S. elections, and people are going to go maybe risk off until the uncertainty plays out, until there's no insurrection catalyst, or is this is the guy who can't put two words together my president, or is the guy who I'm afraid is going to be a dictator? Like, until all of that is resolved and we know who is in power and we know what is happening moving forward, what are the markets going to do? What are the, like, I think people are going to kind of risk off in the second half of the year. So I can see the first half of the year strong, especially when those first couple of rate cuts come out. The second half of the year kind of tail off. And then we'll see what happens from there. I would say I am cautiously optimistic at this point. Everything from a charting standpoint looks bullish. There are dangers that lie ahead, but we get past 53, and I think it is clear sailing. So we'll watch it. I'll keep dropping my thoughts in Discord, and that is all I got for you. Hope you had a great 2023. Cheers to 2024 later.